Welcome, everybody, to the September 2024 Reads Report. Got lots to talk about this month, so we're going to go right away to Mark, and Mark, you're going to kick it off.
Friday, the big NFP report. It added 142,000 jobs, which is below the 160 estimate, higher than the prior 89K level, but the market's a little bit sensitive now to lower labor reports because we've had this big BLS 818,000 revision, and we keep getting lower revisions every month on top of that. By the way, that 818,000 is just a secondary revision. Of course, after the election will be the real full revision, which is likely going to be well over 1 million and break records for the amount of excess jobs that they were reporting that didn't really happen. However, what I would say, the NFP report is kind of, as we'll see, probably more akin to a soft landing than it is growth deceleration, but the market really wasn't pricing in any chance of growth deceleration. And so the combination, this BLS 818,000 excess jobs that were reported and then continuing to disappoint with revisions to the downside on top of it, kind of spooked the market a little bit. The unemployment rate did drop from 4.3 back to 4.2. Remember that 4.3 level is really critical. That's the SOM rule that really triggers an expected recession. We're going to look at a number of things about that. Whether it triggered now is really, really questionable. The other thing that was in the NFP report was average hourly earnings. They rose. That's not something you usually get as you're heading down into recession. So while the market probably still needed to price in higher odds of something other than a soft landing, and really it hadn't been pricing in any, I don't think we're looking at data that tell us, holy crap, we're really definitely looking at a slowdown. Because the report was both positive and negative. Did have a downward revision again of 86,000. That's becoming normal. Somehow, even when they do a big revision on top of little revisions, they still need revisions every month. All of those revisions have been down just before an election. Just amazing coincidence. The 3-month average of job gains is still barely above the amount needed to absorb interest. That's not consistent with the slowdown. That's consistent with kind of a soft landing. So I don't think we can really conclude that we're in a soft landing or not yet. So we really want to be watching things. So we got kind of an initial reaction and then a bigger reaction after the NFP, and we got an 80% down volume day into the bottom of support. What I want people to understand at this point, here's what the market's really groping with. This zero line is based on every rate cutting cycle since World War II ended. And it's basically a regression. And this top line, this sort of darker green, is when you get a soft landing, which is rare. You only get 2 or 3 of those ever. And then most of the time, you're with this sort of bright to lighter green, and you can see the difference between what happens when rate cuts starts is starkly different. Do you have a soft landing? A year later, you're up 17%. If you don't, and you have a growth scare or a recession, you're down 15% plus over the next year. So it's a really big, big decision that the market's got to try to figure out. Do we have rate cuts that are in time to prevent recession this time? Is this one of those rare occasions, or do we not? And so it's going to be very sensitive to data. It's going to be very sensitive to inflation data, but also jobs data, any kind of growth slowdown or not slowdown data. The market's going to be sensitive because really it hasn't been pricing in any chance of recession. Now all of a sudden it realizes that those job gains that it was counting on having happened were made up. And so now when we get further downward revisions and not meeting things, it's like, okay, we've got to price in at least some chance of a recession, not zero. And so that's why we're getting the reaction in markets. We look at a lot of different things, and Chuck really likes this. It is a great indicator, and it's basically different indicators of junk versus treasury debt, yield curve type stuff. And generally, you get pretty clear uptrends in these yield spreads when you start getting recessionary type concerns. We did have a spike. We've gotten up to reasonably, but the trend's been really down, and we really need to break above these August 5 levels to suggest that the yield spreads are starting to confirm that we're getting a significant slowdown. We're starting to see some action that says, watch this, but we're really not there yet in terms of yield spreads. Now, we talked about last time a dollar is likely on this long-term trend down. It has fallen further, and it's hit an important sort of first support level. It's pretty oversold. You can see the MACD has gotten down to prior levels and turned up. You probably need to see, and sentiment is overdone, some positioning is overdone. You probably need to see consolidation or bounce of several weeks before we could really think about shorting the dollar. We'd like to stock a dollar short, but not at these sort of oversold levels. So we really need to watch a dollar, see if we get a bounce or at least a consolidation that allows for more of an asymmetric opportunity in terms of protective stop. But I would continue to stock dollar shorts. And of course, we break through these levels and we've got a lot further downside. And that's probably the case as we start an interest rate cutting cycle. One of the reasons the dollar's been so weak, however, and this is something to really watch closely, and we've talked about it many times, is this dollar yen, right? And so one of the problems on Friday, in fact, Friday, a lot of people would probably suggest that the NFP number wasn't really as bad as the market reacted to at the end of the day. The key problem for the market was this USD JPY, the dollar yen cross. As you can see, we talked about this last month. We talked about how as soon as this broke down, as soon as dollar yen started to break down, that's when the NASDAQ peaked and we started to get our correction. And that correction didn't bottom till dollar yen bottom. We got a pretty good rally in the NASDAQ and even better rally in the S&P, although none of those two made new highs. But you can see that the bounce in dollar yen was much less substantial, and it's actually started to slide again. We had a big slide in dollar yen on Friday, and that's probably part of the reason for the big 80% down volume day on Friday. What I would suggest here, we've talked about how really only about half of the carry trade unwound in this cycle. So there's still $2 trillion of carry trade out there that could still unwind, and the dollar yen continues weak. We had the Bank of Japan saying we're going to continue to raise rates when we can, and we had the Fed saying we're going to start to cut rates. That's why on Friday, the reaction that really hit stocks on a secondary basis was the reaction of dollar yen. Dollar yen looked at the odds of a 50 basis point cut going up and said, wow, that's really gonna unwind that yield curve spread that this whole trade is based on. And it started to unravel a little bit. And as that picked up, market started to drop more consistently. Really want to watch this 140 level, these late December lows. If those give way, we could have another bout of like we had in early August, where we get a capitulation decline in stocks along with the yen. Now, I don't see a lot of things that are going to lead to thinking that the economy is weakening substantial or anything like that could force that issue between now and next week, September 18, when the FOMC meets and actually cuts rates. But if we do get something like that, we really want to be careful. Watch the dollar yen reaction, and remember that stocks are following them. In this decline, as we discussed, the correlations between the NASDAQ and the dollar yen were very high, even on an intraday basis. usually when you get very high correlations repeatedly on an intraday basis, there's really a clear link between those things. So part of the problem for tech stocks in particular on Friday was really that the dollar yen was starting to unravel again, and a lot of people who borrowed in yen bought tech stocks. All right, so we want to watch that carefully. And the key thing the market's trying to figure out, the key thing the dollar yen is trying to figure out is, are they going to cut 50 basis points next week? If they are, this is problem for dollar yen. If they're not, then we could hold up and bounce, and that could allow stocks to kind of flirt around here for a while. The other thing I want to talk about is this SOM rule, right? This is another indicator that people are really now paying attention to because they're concerned about the growth scare that we've been talking about for a while. They're getting more concerned about it. But did the SOM rule trigger, right? We talked about that NFP report a month ago, that it was really heavily influenced by Hurricane Beryl and the impact in Texas. And really, those are temporary developments. That's not a clear indication. So we wondered if those would be unwound. And this month they were. We got the NFP, unemployment was down. So has that really been triggered? It's a question mark. Even Claudia Somm herself suggests that when you have prime age unemployment not rising by 0.5%, along with regular unemployment, that's not really a clear indication that you have a self-reinforcing negative feedback loop starting in unemployment. And we don't have that at all. And so I would watch this. I would basically treat it as if the SOM rule is close but hasn't been triggered, for thinking that we have a self-reinforcing negative feedback loop in unemployment. We want to watch data going ahead closely. There is clear evidence that job growth is downshifting, but it's probably downshifting more like a soft landing than it is like an actual decline into recession, at least so far. So there's some shifts in payrolls. The 3-month average is down. Unemployment rates come up to arguably problematic levels. The broad unemployment continued to move up. And so all those things are kind of putting the market on edge that, wow, we actually believe these NFP numbers all year. Just to give you an extent, the revisions have erased all the job growth this year, 100% of it, right? So what do you know? Before an election, they made it look like there was a lot of jobs growth. If you listen to the Democratic National Convention, you had both Obama, you had Biden, and you had Harris talking about the great job gains. Those job gains didn't exist. They were made up. All right. So that downward revision in combination with missing, now the market's getting more nervous, and now it figures we've got to price in at least some odds that there could be a recession. Now, we've talked about this before, but it continues to be the case and is more so this month than last month. The market is pricing in as if we're going into recession in terms of rate cuts. We've never had rate cuts this aggressive that the market is pricing in the futures markets without a recession. So I think the market is still quite ahead of itself. And we want to watch out for that if we don't have that recession developing. We do have a number of concerns and a growing list of recession warnings that are being triggered here. ISM manufacturing new orders, a good example, that is down to levels that now suggest recession. We've had manufacturing below 50 in the PMIs now for 5 straight months. And it's very rare to get that without a recession. So there's parts of the economy that are in recession and there are parts that aren't. And we really need to watch carefully because this is a huge impact on markets, which way we go. So how weak the economy and labor market are, that's the key question that the market is groping with. It's probably not going to get key answers. Our suspicion is that there's not enough evidence for the Fed to cut 50 basis points. In fact, if the Fed did cut 50 basis points in September, that would probably indicate panic to the market that actually might be taken as a negative. So I would be very surprised if we get a 50 basis point cut in September. We have some Fed officials like Waller saying, well, All right, I think we're ready to cut, but not maybe just once and not 50 basis points. So there's hawks and doves in the FOMC. I think you iron that out, and it's very unlikely that you get a 50 basis point cut, but we'll see. A 50 basis point cut also may not have the positive impact that people expect, because it's generally viewed as the Fed acknowledging it's way behind the curve and it's panicking.